Hey dreamers, this week I got over $1,000 from one Canadian stock in one day. So I made this video about Canadian stocks because I'm getting quite a bit of dividends from my favorite Canadian stocks this month. And it reminded me of the unique opportunity to invest north of the border. Let me show you what I've got, how much they pay, and what the tax implications are. I think you're going to be pleasantly surprised. All right, so this is what I've got in terms of stocks and shares. Starting with BCE, a telecom company, I've got 16,075 shares, total value of $89,000. The yield is 5.26, which kicks off an income of $4,687 or quarterly $1,171. The next one is BNS, Bank of Nova Scotia. I've got 533 shares there for a current value of around $39,000. The yield is 4.3, and that kicks off an income of $1,678. Next one is SJR, which is Shaw Communications, another Canadian telecom. I've got 1,059 shares. This one's actually a monthly payer. And that gets me to $31,792 in terms of current value. The yield is 3.18%, and that kicks off an annual income of $1,011. Next one is CM, which is Canadian Imperial Bank. I've got 33 shares there for a value of $4,338. The yield is 3.85, kicks off $167 a year. Next one is TULUS, TU, and I just started this position. I've got 101 shares of that for a value of $2,438, and the yield is 4.4, kicks off about $107. And then ending, these are actually relatively new positions, TD, Toronto Dominion Bank, 12 shares of that for almost $1,000. 3.47 is the yield, kicking off $33 a year. And then finally, RY Royal Bank of Canada. I've got 7 shares of that, and for a current value of about $837. The yield is 3.19, and it kicks off $27. So in total, these top 7 Canadian stocks, I've got 3,422 shares, almost $170,000 worth, and the yield across all of those is 4.58, and it's making me $7,711 per year. So let's take a look at some of the core stats. Now, these are the questions I always ask, which is, what is the dividend yield? How long have they been paying, and have they been growing the dividend? What's the beta, or how volatile is the stock? Do they have enough cash flow to pay for the dividend, which is the payout ratio, and are they growing, which is the CAGR? So as you can see here, BCE has a low beta of 0.5, which is fantastic. You want it to be under 1. They've had 3 years of dividend increases. And all of these right here should be a red flag. Anytime you see, low dividend years of increases, that should be something where you do your research and figure out what's the issue here, why is this happening, and I'll give you more context as to what is happening later in this video. So one of the things I wanted to do is show you, for context, the consecutive years of dividend payouts. So here we can see 32 years for BCE, and a payout ratio of 96%. So this is another red flag. Anything, above 60, 75% starts to become a red flag, because, that means that maybe they don't have enough free cash flow to pay the dividend, which is what you obviously want them to have enough cash flow to pay you your quarterly dividend without fail. So we'll dig into that payout ratio a little bit later as well. So the 5-year CAGR is 6.17, which is nice. So a couple of red flags for us to dig into, which is the number of years of dividend increases and the payout ratio. What's going on there? Okay, for BNS, we've got 4.31 as the yield, good 0.9 for beta. This is what we want to dig into in terms of the dividend increases, 32 years of consecutive payouts, and a fantastic 46% payout ratio. This is about as low as it can get. They have a good 5.84 CAGR, 5-year CAGR. On to Shaw, they have a 0.7 beta, which is fantastic. Not so good dividend increase record, great consecutive payout record of 35 years, an okay 74% payout ratio, and then a not so great 5-year CAGR at 1.03. CM, we have a 1.1 beta, just a little bit over the 1.0. Not so great in the dividend increase, 32 years of consecutive years. Payout, 42% payout ratio, which is fantastic. 5.4 5-year CAGR, which is good. And then we have TU, a 0.7 beta, 31 years of consecutive payouts, 92% payout ratio. That's really high, so that's something that you'd want to dig into. And then a 6.41 5-year CAGR. TD, 1.0 beta, 1 year of dividend increases, 32 consecutive years of payout. Fantastic. 41% payout ratio, super conservative bank. A great 5-year CAGR at 9%. And then finally, RY, 0.9 beta, 2 years of dividend increases, 32 years of consecutive payouts. Fantastic. 42% payout ratio, and a good 5-year CAGR of 7.21%. Now let's go ahead and address these low dividend increase years and also just talk about the pros and cons of these stocks. Let's start with the banks. So the Canadian banks are amongst the strongest in the world. And one of the reasons for that is just that they're heavily regulated. Case in point was in the early days of the pandemic, their regulatory oversight, OSFI, forbade Canadians' big banks from raising their dividends or hiking executive compensation in case that cash was needed elsewhere. So that is why you see the only 1 year of increases, because essentially they had to skip a year. Before that, they had significant increases every single year. So then we see here in November, the regulation said, kind of gave them the okay to go ahead and raise dividends, etc., go back to normal. So the reality is that these banks have had a very strong balance sheet, and they've actually saved more cash by not paying any dividends for a little while. So they are in a very strong position. Let's switch gears and talk about BCE. So that was, BCE and some of the other telecoms tell us they are showing that high payout ratio. So this is the con, right? This is what we see in this article. That essentially the concern is that the cash flow is not going to be able to sustain this level of dividend. And you can see the dividend yield here in the kind of dark blue, and the dividend per share here in the kind of, I guess that's green. And then the earnings per share here in pink. So, essentially this article is right that, it is a little concerning to see that cash flow, as high as 96% and at times even over 100%. And so this is what you saw before, 3 years of consecutive dividend growth, but 32 years of dividend payouts. And this is what that looks like, essentially, is that over the past 10 years, it has not had a straight line increase in dividends. And you can see the yield here as it goes, kind of goes between 7% down to 6%, down to 5%, 4.9, and back up to 5.36. So if you like to see a straight line, this may not be the right stock for you. For me, having a guaranteed, pay out between 5 and 7% is something that I'm willing to have. So now there's other, as you do your research, there's always going to be people on both sides of the fence. And, on the other side of the fence is the argument that BCE has a huge moat, that they're one of the biggest Canadian telecom companies, that they will see an increase as they build out 5G, and that in the meantime you get that high dividend yield, backed by a strong balance sheet. So that's just the pros and cons of it. In addition, the idea that with inflation, a lot of people are looking for steady returns. So that is causing folks to come to these kinds of stocks. And the effect of that is, I started buying BCE in 2020. And so the past year, you can see not only do you get that 5% yield, but the stock itself has grown 22%. That is not a bad deal. Here's BNS. The stock has grown 31%. Here's CM, grown 46.5%. You've got TELUS that has grown 14% in the last year. TD growing 38% in the last year. And Royal Bank of Canada, 38.75. These are really nice increases in the stock price, in addition to those high dividend payouts. Now, let's turn our attention to Shaw, because this one's a little bit of a head wiggler. Now, I started buying Shaw back in 2020, and the reason why I started doing that was it was paying about 5%. It was a steady eddy, didn't really go up or down, no growth, but it paid every single month. So I just wanted something that would give me monthly income, 5%, a good deal, and that's what I did. So you can see over the last year it's grown 71%, but it pretty much happened in one day. So let's take a look at that. So that one day was, I think it was March 15th of 2021. And that day, they basically made an announcement that Rogers was going to acquire Shaw Communications, and they were going to pay a little bit of a premium, $40. So right when that happened, the share price jumped. And you saw after that, it's been a pretty steady, stock after that. So I didn't know about that. Obviously, this is where kind of luck comes into stock investing sometimes. But the good news here is that with Rogers acquiring Shaw, it means that these two companies will have really good growth potential to go coast to coast for Canada in telecom. And I don't know now, so that's the positive. Now here's the negative. I don't know if you've been watching Succession on HBO, but it seems to me like a little bit of what you can see on that show is happening with this potential merger. Apparently a little bit of drama in the boardroom here. And the good news is that it's unlikely to impact the deal. But essentially, if you read about it, you can see that, the board at Rogers voted out the chairman, who was the son of Ted Rogers, who, has passed. And then, sort of hours later, there was a little bit of a power struggle here, and the family-controlled entity that owns the majority of the shares said he would remove 5 of the board directors who had acted against him. And so this is this is a little bit of a negative in my mind, just because obviously there's turmoil here. And you never want to see that in a company that you are investing in. The structure of the Rogers Control Trust is really unique, and essentially normally control would be split up, but Ted Rogers' estate set up the trust to represent all family members together. So there's basically 97% of ownership shares controlled by that one family trust. So what they're saying is that this deal is going to go through because most of the shares are owned by that one person who wants, or the one trust who wants this to go through. So a little bit of drama here while we wait for the merger in 2022, but likely to go through. And in further research, you can look into Morningstar that basically goes into detail about what's going to happen after the Roger Shaw merger. And, essentially they're saying, look, it's going to close, the deal's going to close, and the dividends really should just continue. So, they're saying here, we don't think it'll get raised, but it won't be cut. And the interesting thing, too, is that as far as BCE and TELUS is concerned, it's not going to have any bearing on them either in terms of being cut. In fact, they think that this deal will be good for BCE and TELUS. So, and then they kind of go on to say that BCE is their top pick and that they have a lot of, amazing growth prospects in the future, et cetera, et cetera. So once again, just a reminder, do your own research, take a look, dig in beyond the numbers, and just get some context to what you're seeing on the page. I'm going to leave you with a note on Canadian dividend stock taxes. Now, I'm not a tax pro, so always consult a tax professional for advice. However, my understanding is that Canadian stocks have 15% withholding for those in the U.S., which is much less than other countries' withholding if you hold it in a taxable account. But if you hold your Canadian stocks in a non-taxable account, such as a U.S. retirement 401k, 403b, or IRA, the tax should actually be waived for Canadian stocks for U.S. residents. And that's due to a special treaty between the U.S. and Canada. So it's yet another reason to go Canadian versus other countries. I've actually held a variety of foreign stocks for the first time this year. So after the tax season, maybe I'll give an update with my experience, as I think some foreign taxes withheld can be used as a credit to reduce the tax bill for even the taxable accounts. Okay, guys, that's it for today. I really hope you enjoyed the tour of my favorite Canadian stocks. As always, I encourage you to keep learning, keep implementing, do your research, and then put it into practice. As a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only, and I'll see you on the flip side.